Mike, we got a sell-off today. Has this been brewing? Are we due for a pullback? And is it because, do you think, of some strong jobs data?
So I think today we have a short-term knee-jerk reaction to the reality that the Fed's not cutting interest rates anytime soon. But when you take a step back, I like to call it a tale of two cities. When you look at the charts of these big tech names and the overall indices from a price action standpoint, it looks like we are in a raging bull market. However, when you take a step back and you look at the economic data, aside from a lot of jobs data, which I say is affected by seasonal adjustments, which I believe are, you're simply just throwing darts there with a lot of what the BLS does in these seasonal adjustments. So I wouldn't read too much into that. But when you look at the ISM data we got on Monday and the factory orders data we got yesterday, in addition to the yield curve, the economic data right now is screaming recession. We are massively inverted on the yield curve, and that has 100% accuracy of a recession historically. So something's got to give. Either the economy needs to improve dramatically or we need to see a massive sell-off in stocks.
You say you're worried about the disconnect between the economy and the markets. How does that play out, do you think, in the second half of this year?
So it's hard to say. It's very, very hard to say because the performance of the stock market this year relative to the earnings data, which this quarter is expected to be down 6%. The fact that the Fed hasn't loosened anything, they've injected some liquidity with some of these bank bailout programs after Silicon Valley Bank, but short-term interest rates are well above 5%. And then in addition to that, you have all the leading economic indicators down every single month for over a year. So in those times, typically earnings multiples compress. But what we've seen is since November is earnings multiples expand by over a third. So you've got to believe it's the stock market. However, the charts of these stocks look like the way that they are right now if large institutional investors believe that. So, I'm a little bit dumbfounded, and I'm trying to play both sides of this.
Are there any particular stocks that you like right now, Michael?
Yeah, so as I just mentioned, I'm trying to play both sides with somewhat of a barbell approach. So the sectors that are working really well right now, so technology, XLK, the consumer communication sector, XLC, and the consumer discretionary, XLY. Those contain all these 7 or 8 large names that are driving the overall market. Okay, as well as the long bond, the 30-year treasury, the TLT. So that long bond, should the stock market start to fall apart, should we enter a recession, should things deteriorate dramatically, that will protect your overall portfolio. And if we just sort of chug along here and interest rates don't move that much, we don't enter a recession, that should hold steady and pay you over a 3% yield.
Are you in the camp that you think the Fed is indeed going to raise 2 more times by the end of the year?
Well, look, I would say we're getting at least one right now. And if we continue to get this jobs data and inflation stays sticky in wages, particularly as it has been, we may get more than 2 hikes. But I think the most important part about that is rate cuts are very far away without substantial and significant economic deterioration from here.
All right. When you look at these short-term treasuries, with the 10-year now above 4%, the 2-year, to your point, has been inverted for so long now. But we've talked about recessions for a long time and still not there yet.
Yeah, well, I think we're still getting our arms around about how much $8 trillion into the economy is, because between the fiscal stimulus from the federal government and the Fed expanding their balance sheet, $8 trillion is still sloshing around, and you have over $5.5 trillion in money markets right now. And to remove that from the system is most likely going to take more work from the Fed. Because without removing enough of that liquidity, you're not going to get inflation under control. And if we don't get inflation under control, interest rates are not heading down anytime soon. So this is as difficult a time to invest as I have ever seen.
Yeah, it's very challenging indeed. Michael Lee, thank you so much, Mike. Appreciate your time this morning. Thank you.